Okay, let's unpack this. Imagine having a superpower in the world of investing. Not the ability to predict the future, mind you, but something maybe even more valuable. The wisdom to know what you don't know.
Hmm.
What if that was the real shortcut to being a truly well-informed investor?
That's a powerful starting point for sure, and one that really guides our deep dive today.
Exactly. Welcome back to the deep dive. Our mission, as always, is pretty straightforward. We take a stack of information you've shared with us, articles, research notes, whatever it is, and we try to cut through all the noise.
Hmm.
We're here to pull out the most important knowledge, the surprising stuff, and, give you that shortcut to being genuinely well-informed without drowning in data.
And for this deep dive, we're zeroing in on some really insightful material. We're looking at excerpts from Nicole Lapin's book, The Money School, specifically pages 60 through 87.
Right.
This section covers what she calls Stocks 301 fundamental and technical analysis.
And the goal here is, well, it's pretty ambitious, but really crucial. To break down the main ways people assess potential investments, what's known as fundamental and technical analysis.
Yeah, the two big pillars.
We want to get into how you can apply these, what the key numbers and ideas actually mean, and maybe most importantly, how to spot some common traps that can trip people up, even experienced folks.
Definitely.
And we'll be using specific insights, dates, and even some direct quotes from Nicole Lapin's book to, make it all feel a bit more real.
And she starts this whole section, quite fittingly actually, with a story that takes us way back, like over 2,500 years back.
Right, page 60, she kicks off with Socrates and the Oracle of Delphi. Now, the Oracle back then, this was a huge deal in ancient Greece, right? Seen as this prophet whose words carried, well, enormous weight.
Absolutely. And sometime in the 420s BCE, the oracle declares that Socrates is the wisest person in all of Athens.
Which apparently just baffled Socrates. He didn't buy it.
Not at all. According to the story, he was completely bewildered. So he sets out on this quest, basically, to prove the oracle wrong. He starts seeking out everyone in Athens who had a reputation for being smart, the smart cookie street cred, as Lapin puts it.
Yeah, so the poets, the politicians, the religious figures.
All of them. He'd go up and ask them these really probing questions, trying to dig into their supposed wisdom.
And what did he find?
Well, time after time, he found these supposedly super knowledgeable people would just give him, as Nicole Lapin kind of wryly puts it, BS answers to sound important and all-knowing.
Lots of words, not much substance.
Exactly. They sounded confident, used a lot of wordy nonsense, but didn't really hold up under scrutiny.
Okay, so this leads to his big realization, right?
Yeah, his famous insight. Maybe he was the wisest, but not because he knew more. It was because he was the only one who actually understood how much he didn't know. He recognized his own ignorance while everyone else was pretending they had all the answers.
Which brings us right back around to investing. The connection the author makes on page 60 is, well, it's spot on. She writes, and I'm quoting directly here, when it comes to investing, be like Socrates. Be wary of anyone whose answers are wordy nonsense spewed to help them look like the smartest person in the room.
It's such a good caution because the financial world, as she points out, is just teeming with people like that. People who project this aura of absolute certainty, people who claim they can predict what's coming next.
And often that confidence, that I know everything vibe, is used to convince you to trust them, maybe hand over your money, without really questioning it yourself.
Yeah, do your own thinking.
So the first lesson, even before we get into the tools, is maybe adopting that Socratic humility, that healthy skepticism. Knowing nobody has a perfect crystal ball is actually like your first line of defense in investing.
It really is. It protects you from falling for those confident but ultimately maybe baseless claims.
Okay, so with that Socratic wisdom packed in our back pocket, let's look at the core methods Nicole Lapin lays out for actually trying to understand investments while still accepting we won't have perfect foresight. She talks about two main ways to analyze things.
Exactly. On page 61, The Money School introduces these two primary types of analysis: fundamental analysis and technical analysis.
How does she differentiate them right off the bat?
Okay, so fundamental analysis, she explains, is about looking at the easily accessible information. Think news reports, financial statements, that kind of stuff.
Right.
The goal is to figure out the general health of an investment over time. This is more for the long-term investor, looking at a company's real underlying value. She sums it up nicely as mostly the study of words.
The words. Okay, and technical analysis. What's the focus there?
Technical analysis flips the script. It focuses on the company's share price and volumes. The aim here is different. It's about trying to spot trading patterns to forecast where the price might go next.
So more short term.
Yeah, definitely favored for short-term trading. And this one is the study of numbers, price charts, trading volumes, that sort of thing.
So words versus numbers.
Yeah.
Different tools for different jobs. The book has a table on page 61 comparing them. Let's pull out a couple of key differences beyond just words and numbers.
Yeah, the time horizon is a big one. Fundamental analysis is geared towards long-term investment decisions. You're thinking months, years, maybe even decades ahead.
Right. What's this company worth down the road?
Exactly. Whereas technical analysis is all about short-term trading decisions, looking at patterns over days, weeks, sometimes even just hours or minutes.
And the actual focus is quite different too, isn't it?
Completely. Fundamental analysis wants to evaluate a company's intrinsic value based on financial performance and industry position. What's it really worth deep down? Technical analysis, it doesn't really care about intrinsic value. Its focus is purely on forecasting future price trends based on historical market data and price patterns. It's asking, where's the momentum? Where might the price go next based on past behavior?
And fundamental use is both qualitative, like judging the management team, and quantitative, the actual financial numbers.
Right, qualitative and quantitative. Technical, though, is strictly statistical and pattern-based. Charts, volume, mathematical indicators derive purely from price and volume data.
Got it. So very distinct approaches. Page 61 makes that super clear.
Yeah, and understanding which lens fits your goal investing versus trading is kind of the first step before you even pick up the tools.
Okay, let's grab that first lens then. Fundamental analysis, the study of the words. The book dives right in, saying a huge part of this is just paying attention to the news, right?
Absolutely. Page 62 really emphasizes that the stock market isn't this isolated thing. It's greatly influenced by current events. She gives examples like elections, natural disasters, pandemics, big external shocks that can send ripples or even waves through the markets.
Yeah, she mentions how watching the market react during the pandemic, travel stocks crashing, cleaning supply companies booming made her even more skeptical of anyone claiming to have all the answers. Stuff happens.
Exactly. Unexpected stuff reinforces that Socratic point again. So the book suggests tracking news in two main areas.
Okay, what are they?
First is news about the specific company you're interested in or already own, what's actually happening with their business.
It's like operational stuff.
Yeah, page 62 gives examples. Are they announcing big plans for earnings growth? Launching major new products? Are they talking about merging or acquiring someone? Expanding into new countries? Stuff that directly impacts their future performance.
And there's a great little warning on page 62 about buzzwords.
Oh yeah, that's a good one. She says, don't be fooled by good marketing and overuse buzzwords like innovation. If a company has an innovative product, they probably don't need to tell you it's innovative.
It's like her other point. Just like if someone is really powerful, they don't need to tell you they're powerful. Same goes for rich. If it's real, the results should show it.
Precisely. Another key piece of company-specific analysis, highlighted on page 63, is the leadership, who is in the boardroom.
Like the CEO, the directors.
Has the CEO changed? And importantly, is the leadership team diverse? Does it actually reflect the customers they're trying to reach? She uses analogies from shows like Succession and Mad Men to make this relatable.
Why does she emphasize that diversity piece?
Well, her point is we all have these cultural and social blind spots. If everyone making the big decisions is basically the same demographic clones, she calls them, they probably share the same blind spots.
Right. They might miss something important.
Exactly. A diverse team is more likely to catch important trends, understand different customer groups better, and avoid costly mistakes that come from just one perspective. Plus, she adds that reminder on page 63, when you invest, $1 is a vote on those values. So support companies whose leadership aligns with what you believe in.
And practically speaking, how do you actually track all this company news? Page 63 has a money tip. Stay alert.
Yeah, she gives some straightforward ways. Check the Investor Relations tab on the company's own website. That's their official channel. You can also set up custom RSS feeds or use things like Google Alerts for the companies and Adderall their executives. Just ways to get important news pushed to you.
Okay, so that's drilling down on this specific company. But fundamental analysis also means zooming out, right? The second category of news. General economics news.
The macro stuff. This is about the overall economic vibe check around the globe, as she puts it, and that general feeling will affect markets.
How so?
Well, page 64 points to examples like the huge market drops at the start of the pandemic, or how the Silicon Valley Bank collapse in 2023 really shook the whole banking sector. Even conflicts like in the Middle East affecting oil prices spread through the market because, as she says, it is all interconnected.
Okay, so to get a handle on that big picture, pages 64, 65 talk about getting familiar with key economic reports and indicators. She admits they sounded intimidating to her at first, too.
Yeah, they can sound dry, but market reactions are often tied directly to these numbers. Page 65 lists several key ones that the pros watch constantly. We should probably touch on a few.
Definitely, like gross domestic product GDP.
Think of GDP as the economy's main report card. It measures the total value of all goods and services produced in a country. Comes out quarterly and annually. Big picture, is the economy growing or shrinking?
Okay, then the unemployment rate.
That's the percentage of people actively looking for work who can't find it. Released monthly, seasonally, annually. It's a key sign of the labor market's health. More jobs usually means more people spending money.
And for inflation, she mentions two key indexes, CPI and PPI.
Right. CPI is the Consumer Price Index. It tracks the average price consumers pay for a basket of typical goods and services. Comes out monthly. It's our main measure of inflation hitting your wallet.
And PPI.
Producer Price Index, also monthly. Tracks the average prices producers get for their goods. It can be an early warning sign for future consumer inflation, as costs move down the supply chain.
Got it. There's also consumer confidence in retail sales.
Yeah, both important for gauging consumer behavior. Consumer confidence monthly surveys how optimistic people feel about the economy. It tries to predict future spending. Retail sales, also monthly, measures actual activity in stores or people buying more or less stuff. Big drivers of the economy.
And industrial production.
That tracks the output from manufacturing, mining, energy sectors monthly. Gives you a read on the health of the industrial side of the economy.
Lastly, housing market indicators.
Things like housing starts, permits, home sales prices, usually monthly and quarterly reports. The housing market's a big one. Buying a house is a huge decision tied to confidence and economic strength, often seen as a leading indicator.
And woven into this discussion on page 64 is a quick note about black swan events.
Ah, yeah, the FYI box. The term comes from Nassim Taleb's 2007 book, The Black Swan. It refers to those really rare, totally unexpected events that have massive consequences and kind of upend everything we thought we knew.
Like the examples the book gives, the total meltdown of the housing market in 2008 or the COVID-19 pandemic.
Exactly. Things almost nobody saw coming, but they completely changed the game. A reminder that massive uncertainty is always out there.
So moving beyond those broad indicators, pages 65, 66 bring in industry trends and, politics.
Yeah, politics. She uses a great historical hypothetical. Imagine you invested in a Cuban cigar company back in 1960. Seemed okay, right?
Sure, if the company was solid.
Right. But then, bam, 2 years later, the Cuban Missile Crisis hits, and the U.S. slaps an embargo on Cuban imports. Suddenly, no matter how good that cigar company was, its main market just vanished overnight because of politics.
Wow, yeah, that really drives home how external stuff can just sideswipe a business.
Totally. Which is why the book says you need to ask questions like, is new legislation coming that could hurt or help this industry? Is their core technology about to become obsolete? And the biggie, as she calls it, will this industry be affected by which political party is in office?
Because, as page 65 states pretty bluntly, politics always moves markets. What governments do or say they might do really matters to investors.
And page 66 clarifies two types of policy that often get mixed up. Fiscal and monetary policy.
Okay, what's the difference there?
Fiscal policy is the government's toolkit, using taxes and government spending to steer the economy. Think tax cuts or infrastructure projects.
Got it. And monetary.
Monetary policy is the central bank's job. In the U.S., that's the Federal Reserve, or the Fed. They use tools like interest rates and controlling the money supply to try and keep the economy stable and inflation in check.
Speaking of the Fed, pages 66-68 introduce what the author calls your new frenemy, the Federal Reserve.
Yeah, the Fed.
Yeah.
Led by a chair appointed by the president. Their main gig is using that monetary policy to keep our economy in balance. They also supervise banks, and yes, they're the ones printing our money.
And they have regular meetings that are a big deal.
Huge deal. Page 67 notes they meet 8 times a year. And a key decision is setting the target for the federal funds rate. This is the interest rate banks charge each other for overnight loans. The book calls it the master volume knob for the economy.
Good analogy. So turning that knob up or down affects what?
Pretty much everything. Inflation, employment, the interest rates on all types of loans. Whether you're a giant corporation borrowing billions or just someone getting a mortgage or using a credit card, the cost is tied back to that Fed rate.
And that impacts businesses, consumers.
Absolutely. Affects business investment, consumer spending, company profits, stock prices, all of that ultimately. The markets. It's a massive lever.
Page 67 also mentions the prime rate. What's that?
The prime rate is what banks charge their very best customers, usually big corporations. It's basically the federal funds rate plus a little extra for the bank's profit. It acts as a benchmark for lots of variable rate consumer loans too, like home equity lines.
Okay. And the book quickly notes on pages 67, 68 that other countries have their own central banks doing similar things. The ECB in Europe, Bank of England, Bank of Japan, People's Bank of China.
Right. They run the show in their respective economies, and their decisions ripple globally, too. More interconnectedness.
Okay. So we've covered the external words, news, economy, politics, central banks. Now, fundamental analysis also means digging into the company's own financial health.
Exactly. Time to look inside. Page 68 shifts to the company's documents, starting with the profit and loss statement, or P&L, and she kicks us off with a really funny, relatable story on page 68.
The P&L confusion.
Yeah. She says when she first heard PL, she literally thought people were just saying her initials, NL, and maybe asking if she needed a bathroom break before a meeting or going on air.
That's hilarious. Shows how weird this jargon sounds at first.
Totally. She quickly learned it wasn't about needing to pee, but it could tell you whether a company is going down the toilet.
What is the P&L, basically?
It's just a spreadsheet, really. Tracks income and expenses over a specific time, like a quarter or a year, to show the net profit. That's the bottom line, what the company actually keeps after all the bills are paid. Page 69 gives the simple formula. Gross profit expenses, net profit.
Okay. And pages 69 70 show a super basic view first, using two made-up companies, MSKL, Money School, and ICK. MSKL made $1 million net profit 2 years running. ICK went from $1 million to $1.1 million.
Right. So just looking at that, ICK looks better, right? It grew profit. MSKL looks stagnant. And the book says in the market, standing still means falling behind.
But that's not the whole story.
Not even close. Lapin says this simple view gives you half of the story. The real insight comes when you look at why the numbers changed. Pages 71, 73 give the full P&Ls for both, and it completely flips the script.
Okay, let's look at MSKL's full P&L first. Net profit was flat at $1 million.
Yeah.
What else changed?
Well, their gross profit revenue before expenses actually jumped significantly, from $1.5 million to $2.5 million. That's great.
But their net profit didn't grow.
Yeah.
So expenses must have gone way up.
Exactly. Expenses tripled from $500K to $1.5 million. But why? The book breaks down the fictional expenses. Payroll and office space doubled. Sounds like they hired more people, needed more room. And there's a big new line item for R&D, research and development. They're investing in creating new things.
Ah, so the high expenses were actually signs of growth and investment.
That's the conclusion on page 73. When expenses represent the company investing in itself, hiring, expanding, innovating, that can be a great sign. They're spending money now to hopefully make more money later.
Okay, now contrast that with ICK on pages 72, 73. Their net profit went up, which looked good at first glance, but what happened to their gross profit?
It actually decreased. It went from $1.5 million down to $1.4 million. They brought in less revenue.
So how did net profit go up then?
By slashing expenses. They cut costs from $500K down to $300K.
And where did those cuts come from?
The details show cuts in payroll and office space, which, as the book points out, likely means that employees were laid off and branches were closed. That's not telling the best story. Those are generally both bad signs. They boosted the bottom line by shrinking, not by growing.
Wow. That comparison makes the point so clear. You absolutely cannot just look at net profit. You need the P&L details to understand the story behind the numbers.
Exactly. High expenses can be good if they're smart investments.
Yeah.
Low expenses can be bad if they come from cutting the core business. Like her funny example. A winter jacket company spending tons on travel to Barbados. Probably funny business, not R&D.
Okay, beyond the P&L, fundamental analysis uses the balance sheet, right? Page 74.
The balance sheet shows a company's equity, basically how much the company is worth at one specific moment in time.
And the formula is like personal net worth.
Yep. Assets, liabilities, ex equito. Page 74 boils it down to what the company owns versus owing.
What kind of assets does page 75 mention?
3 types. Financial assets like cash and investments, tangible assets, physical stuff like buildings, machines, inventory, and intangible assets, non-physical things like patents, brand names, and intellectual property. Tangible and intangible need to be sold to become cash value, though.
And the balance sheet is described as typically a little bit more clear-cut than a P&L. What's the main thing to watch out for?
Page 75 calls out one big honking red flag: decreasing equity. If the gap between assets and liabilities is shrinking, it probably means debt liabilities is growing faster than assets, which increases the risk of, well, bankruptcy.
But you still need context, right? Page 75, 76 warns about assets that might not be solid.
Yeah, great point. Don't just see $1 billion in assets and think it's amazing. If those assets are all tied up in some sketchy cryptocurrency called Fire Festival Coin 420, as she jokes, that's not real, reliable value. Got to look holistically.
Okay, the last key documents for fundamental analysis. Page 76, the 10K and 10Q reports.
These are the official financial reports companies have to file with the SEC, the Securities and Exchange Commission. The 10K is the big, detailed annual report. The 10Q is the quarterly update.
And why are these so important?
Because they're overseen by the SEC. Page 76 notes, the numbers in them have less room for added pizzazz or, creative storytelling compared to maybe a press release or an internal P&L. They're the official audited figures.
But they're also notoriously dense. Page 76 mentions the joke about running a 10K is easier than reading one.
Yeah, they are definitely jargon-filled mazes.
So what's the practical advice on page 77 for someone listening? Do you need to become an expert accountant?
Not necessarily. The author suggests that analysts will dig deep into these, and you can often find their summaries from reputable sources like Morningstar, Bloomberg, and the Wall Street Journal. Many offer free newsletters or summaries.
But doing some digging yourself is still good.
Yeah, especially if you're thinking of making a big bet. Any personal checking is valuable. It's about verifying the company's story. Page 77 says headlines talk about potential sales. These reports show if they're actually selling stuff. Does the story add up to the data?
She also suggests just building a habit, right?
Mm-hmm.
Page 77.
Read one business news story or newsletter daily, like checking Wordle results. Just getting that regular exposure to the language and the big players is a great place to start. Makes it all less intimidating over time.
And that cool tip on page 78 for New Yorkers. Free access to Bloomberg terminals at the public library.
Yeah, amazing resource if you can get there. Access to the pro level stuff.
Okay. That's a solid tour of fundamental analysis, the words, news, economy, financials. Let's switch lenses now to technical analysis, the study of the numbers.
Right. Page 78 starts this section, and page 79 admits these stock metrics can look like Egyptian hieroglyphics on a screen at first. The goal here is to decode them, using that MSKL example data again, which the author found helpful herself.
Okay, the example data on page 79. Symbol MSKL, price 20, open 19, high 20, low 18.5, vol 1000, 52WH20, 52WL10, beta 1, div 2, dividend yield 0%, EPS 10, PC2, NKT cap 20M. Let's break down some key ones.
Sure. We see the symbol, MSKL, just the company's ticker or nickname, page 80. Then price, $20, the current price. The book notes it's up from the open price, $19, so a good day so far. We also see the day's high GH, $20, and low $18.50. Pretty straightforward.
Then VL volume. What's that about?
Volume is the volume of shares traded within a time frame, usually the day, page 81. Here it's 1,000. Realistically, it's usually in millions. High volume just means lots of trading activity, lots of buying or selling interest. But as the book warns, pros don't rely only on volume.
Okay. Now, pages 81, 82 highlight two metrics the author really likes to watch, the 52-week high and 52-week low.
Yeah, these show the highest and lowest prices the stock hit over the past year, page 81. For MSKL, the high is $20, the low is $10. And the interesting thing is the current price, $20, is at the 52-week high.
And the book says, looking at these three, current price, 52-week high, 52-week low, kind of tells a story together.
It does. If the current price is near the high, especially with a big gap between high and low, like MSKL, 20 versus $10, it suggests the stock's growing in value or on an upward trajectory. If it were near the low, it could mean that the stock is on sale compared to its recent past.
She uses that funny dating profile analogy on page 82.
Yeah. You see the amazing photo, 52-week high, and maybe a less flattering one, 52-week low. But you need to see the person IRL in real life, the current price, to know what they actually look like now. Same idea. Current price gives context to the historical high and lows.
And a big gap between the high and low might mean volatility.
Exactly. Could mean the price jumps around a lot. Page 83, which, as she notes, most investors find unappealing, like dealing with volatile people.
Which brings us to volatility itself, and beta. Pages 83-85. Page 83 also mentions the VIX.
Right. The VIX is often called the fear gauge or fear index. It's like a market anxiety thermometer. High VIX suggests traders expect big swings, maybe time to be cautious or look for dips. Low VIX suggests complacency, maybe things are too calm.
So VIX is about the market's expected volatility. Beta is about a specific stock's volatility compared to the market.
You got it. Beta measures how much a stock tends to move relative to the overall market. The market itself has a beta of 1. A beta between magnitude 1 and 1 means less volatile than the market. Above 1 or below magnitude 1 means more volatile.
The book gives examples. Verizon, a stable utility-like company, beta 0.45, less volatile. EOG Resources, an energy company, beta 2, twice as volatile.
And page 85 explains negative beta 2. That means the stock tends to move opposite the market. Market down, stock up. Gold is often an example. People use these as hedges sometimes.
And beta isn't inherently good or bad, right? It depends on the market and your own stomach for risk.
Exactly. And page 85 has a quick FYI on alpha too. Basically measuring performance versus similar assets, it's edge. But it's a trailing indicator, looks backward.
Okay, next, dividends. DIV and dividend yield on page 86.
Simple ones. DIV is the annual dollar amount shareholders will get per share. Dividend yield is that amount as a percentage of the stock price. Annual dividend current stock price. A dash just means no dividend paid, not necessarily a bad thing. They might be reinvesting profits.
All right, now a really big one. EPS, earnings per share, page 86.
EPS measures profitability with respect to the number of shares available. How much profit per share? But crucially, it's not cash you get directly unless paid as a dividend. Page 87 gives the formula, net profit number of shares outstanding.
Using the MSKL example. $10 million net profit divided by 1 million shares outstanding gives an EPS of 10.
Seems simple, but page 87 immediately shows why EPS alone can be tricky using ICK again. If ICK only made a $100 profit but only had 10 shares, its EPS would also be 10. $100, 10, 2x 10.
Whoa, so same EPS, but wildly different actual profits.
Yeah.
10 versus $100.
Just because of the number of shares.
Exactly. Shows you have to look deeper, connect it back to the P&L, understand the context, don't just grab the EPS number.
Okay, and that flows right into another big metric, the PE ratio. Price to earnings, page 87. The PE ratio looks at the relationship between the stock price and earnings per share formula. Stock price EPS, page 87. For MSKL, it's $20 price divided by 10 EPS, giving a PE of 2.
Now, the old rule of thumb is often lower PE is better, meaning cheaper. But page 88 pushes back on that hard.
Yeah, she notes that while maybe 15 is seen as good value, Disney at the time had a PE over 70.
So a high PE isn't automatically bad. Page 89 explains why.
Right. Reason 1 for a high PE could just be the company's losing money, negative EPS. That's bad. But reason 2 is more interesting.
What's that?
The company might be profitable, but is pouring all that profit back into growth, reinvesting heavily, like Disney building out its streaming service. This makes the current earnings look low relative to the price. High PE, maybe even painful-looking financials short term, but it can be a good use of all their money if it fuels future growth.
And this connects to growth versus value stocks on page 89.
Growth stocks often have high PEs because investors are betting on future earnings growth to justify the price. Value stocks tend to have lower PEs, maybe seen as undervalued now. Growth investors really watch for that profit to keep increasing year after year.
Okay, last metric from the example. MKT CCAP, market capitalization, page 90.
Market cap is the total value of a company, specifically from an investing perspective. Simple formula. Number of shares outstanding x share price, page 90. For MSKL, 1 million shares times $20 price equals $20 million market cap.
And the general idea on page 90 is that size relates to risk.
Kind of the conventional wisdom. Bigger cap, maybe less risky. Mega cap company like Apple is too big to fail, that thinking. Smaller cap, potentially riskier, but maybe the most room for growth because they're starting smaller.
Okay. We've defined a lot of terms from both fundamental and technical analysis, but the book has a huge caution about just looking at these numbers at one point in time.
Absolutely critical point on page 92. All of these metrics take the temperature of a stock for one moment in time. You need to see the trend. Look across several quarters or even several years to get the real picture. One snapshot isn't enough.
And these numbers can sometimes be manipulated, right?
Yeah, page 93 gives the prime example, stock buybacks. When a company buys its own shares back off the market.
How did that skew things?
It reduces the number of shares outstanding, which is the bottom part of the EPS calculation. Net profit shares outstanding. So page 93 shows the math. $10 profit 1M shares equals EPS 10. Fine. Profit drops to $5. 1M shares equals EPS 5. Ouch. But what if profit drops to $5 Myers and they buy back half the shares, leaving only $500K outstanding?
Yeah.
Then it's $5, $500 equals EPS 10 again.
Wow. So profit got cut in half, but the EPS looks exactly the same as before, just because they reduced the share count.
Exactly. It artificially boosts EPS, makes it look like profitability per share is holding up, even if the underlying business is struggling. Especially tricky if they're borrowing money to do the buybacks.
Really drives home that point from page 93. Technical analysis is useful, sure, but real fluency comes from practice, from revisiting the individual metrics habitually. It's that Socratic thing again, the more you learn, the more you see the nuances.
And to make this really concrete, the book includes a POPQEZ on pages 94-96, presents real data for a mystery stock.
Yeah, the numbers are pretty wild. Price 347.51, open 354.83, high 380.00, low 249.00, fall 2.201 meter, 50WH 380.00, 50WL 2.57, beta dividend yield, EPS -hours 1.78, PE negative 199.34, MKD cap 24.24B. Just looking at that, what jumps out?
Well, page 95 reveals this was GameStop GME about 8 months after all the hullabaloo, and the author asks, what here screams risk?
She flags three things specifically on page 95.
First, that negative EPS, NIMH 1.78. Straight up, it's a loss. A negative EPS means that the company is losing money. That's a fundamental red flag.
Second, the beta of negative 2.08.
Whoa. Okay, the negative sign means it moves opposite the market, but the size negative 2.08 of it all, that's the kicker. It means the stock swings more than twice as much as the market, but in the opposite direction. She calls this giving big chaotic energy. Unless you love extreme volatility, that's a huge warning.
And third, it was trading below its high for the day and the year, which were both the same peak number, 380.00.
Right. It had hit that crazy high, but was already significantly off it. So, put it together. Fundamentally losing money. Insanely volatile, with an inverse relationship to the market, and trading well below its peak. That's a picture of a stock driven by something other than normal fundamentals, carrying massive risk.
And speaking of risk and real-world consequences, there's that incredibly sobering story, The Confession of a Professor, on pages 91-92, about Enron.
Oh, that's a tough one. The author shares about her freshman roommate's grandfather. Less than a year from retirement, December 2001, he was on suicide watch. He'd lost hundreds of thousands of dollars, basically his life savings.
Why? Because he'd put his 401k heavily into Enron stock.
Yeah, stock that Enron itself had encouraged employees to buy. This was a giant company, $90 a share, $65 billion market cap. And then it just vanished.
How did a company that big just collapse?
Page 92 explains the core fraud based on the book's account. Enron wasn't booking revenue from actual completed deals. They were booking projected revenue from deals that might never even happen, counting chickens way before they hatched.
And when things went bad.
The book says the accountants would do some zooging again, shuffle numbers, assign losses to these off-the-books companies Enron owned but kept separate, hiding the debt, hiding the losses, making Enron's main P&L look healthy when it absolutely wasn't.
The fallout, page 92 says, was devastating. Investors lost $74 billion. Thousands lost their jobs and their retirement savings, like the grandfather in the story.
It's just a tragic but incredibly important reminder about diversification, about not assuming any company is too big to fail. As the book concludes, it was heartbreaking, maddening, and traumatizing, and underscores the danger when transparency fails.
Which leads right into a really practical, necessary lesson.
Yeah.
Dealing with losses. Page 97 starts with a very frank promise from the author.
Yeah, she says, everyone loses money in the stock market. I can't promise you much when it comes to investing, but I can promise you that. Losing is part of the game. The key is how you handle your losses.
And she makes a big distinction between the whole market going down versus just your stock going down.
Crucial difference. When the entire market dips because of a war, an election, a pandemic, it feels scary. New investors might panic and sell everything.
But page 97 gives that historical context. Since its inception, the stock market has never not recovered from every dip and blip in its history.
Right. Page 98 uses the roller coaster analogy. Ups and downs are normal. The advice, chill, don't jump off the ride in the middle. She uses the 2008 crisis example. The Dow fell roughly 50% from 14K to 6.5K. Terrifying. But by the time she read the book, it was near 39,754, way higher than before the crash. Patience paid off.
In fact, page 98 says pros often buy on dips. See it as a sale on good companies. A recession can actually be the best time to buy low for the long term.
That market resilience is not the same for an individual stock that's tanking because the company itself is failing.
Right. Page 99 is clear. The market recovers, but the stock value of a failing company won't rebound. It will just fail. Don't assume a broken company will bounce back with the market. Don't follow it all the way down to the bottom.
You have to distinguish between bad times and bad investments. A market dip is usually external. A company's specific plunge is often internal, signaling fundamental problems.
When to actually cut your losses on a specific stock, page 99 says that's up to your personal risk tolerance, but it warns against a really common mental trap. The break-even fallacy on page 99.
Oh yeah, this one gets so many people. It's the idea that if your stock drops, you should just hold on until it gets back to what you paid before you sell. Sounds logical, but the math is wrong.
How so? Page 100 explains the math mistake.
You think if it drops 30%, it needs to gain 30% to get back even. Wrong-o, as the book says, because the gain is calculated on the new lower price.
Right. If $100 drops 30%, it's worth $70. To get back to $100, that $70 needs to gain $30.
Which is way more than 30% of $70. It's over 42%. A 30% gain from $70 only gets you to $91. Still down.
Page 100 has that great analogy. Falling down takes a whole lot less effort than climbing up. The bigger the loss, the steeper the percentage climb needed just to break even.
And pages 100, 101 have a table showing this starkly. A 50% loss requires a 100% gain to break even. 75% loss. You need a 300% gain. The longer it takes, the more time your money is stuck.
So what's the suggestion on page 101?
At least consider selling an investment if the price is dropping faster than the overall market, without reason to believe that it will reverse its fortunes anytime soon. Don't just hold on blindly hoping.
And our own motivation for selling duds. Page 101 talks about opportunity cost.
This is huge. The cost of holding onto that loser isn't just the money lost so far, it's the potential gains you're missing because that money isn't working for you somewhere else in something that is growing.
She shares that personal story on pages 101, 102 about holding on to losing real estate investments. REITs, she bought it out of FOMO.
Yeah, and finally realizing I could have these thousands of dollars growing in NVIDIA instead. That realization, seeing the opportunity she was missing, pushed her to finally cut ties. Like leaving a toxic relationship when you see what else is out there.
Powerful way to think about it. And page 102 quickly defines some common market terms too. Bulls, bears, bubbles.
Quick definitions. Bear market, market trending down, bears hibernate down. Bull market, market trending up, bulls charge forward. Bubble, investment price is overvalued, way detached from fundamentals, P&L, balance sheet, and bubbles eventually pop.
So after all this focus on analyzing individual stocks, page 103 kind of zooms out again, offering a broader perspective.
Yeah, it's an important point. While learning to analyze stocks is great, page 103 states that putting your money into individual stocks is actually not the only or even best way to invest. She reminds us even the investing legends aren't right all the time picking stocks.
Which leads to her own typical approach, quoted on page 103.
Which is why I typically do not focus the bulk of my investment strategy around specific companies to invest in, but rather funds that include a smattering of different securities. Diversification through funds.
And this brings us to that great analogy on page 104, the chocolate chip cookie method.
I love this one. Individual stocks, the things we've just spent all this time analyzing, are the chocolate chips. They're great, essential even, but they're not the only ingredient. You need the whole cookie mix for a good portfolio.
Just baking chocolate chips alone doesn't work.
Nope. Unhappy smoke alarm, as she puts it. A good portfolio, like a good cookie, needs a variety of securities, not just stocks, to be balanced and satisfying. It's a really simple, effective image for diversification.
Wow. Okay. We have really covered a ton of ground here, pulling directly from pages 60 to 87 of Nicole Lapin's The Money School. We went from Socrates to P&Ls, from beta to buybacks.
Yeah, we unpacked fundamental analysis, the words like news, economic reports, digging into those financial statements, the P&L, the balance sheet, the 10Ks.
And then we tackled the numbers of technical analysis, defining metrics like volume, beta, EPS, PE, market cap, and seeing how they tell a story, but also how they can be, well, potentially misleading if taken in isolation.
We saw the importance of trends over snapshots, learned from huge failures like Enron, talked about handling losses and avoiding that break-even trap.
And finally, putting individual stocks in context with that chocolate chip cookie idea of diversification through funds.
These tools and insights, straight from the source material, really do give you, the listener, a much more informed way to look at potential investments. Getting fluent takes practice, like the book says.
And, the book mentions the reward for getting investing is money, which is obviously motivating, easy to get hooked on. But thinking about that Enron story,
Yeah.
the wild ride of GameStop, that break-even math.
Yeah. It makes you wonder, doesn't it? Is the ultimate reward just the money itself? Or is it maybe something deeper, like the empowerment that comes from truly understanding the risks, knowing nobody can predict the future perfectly, and having the wisdom to navigate it all carefully, responsibly?
That's definitely something to chew on as you continue your own learning journey. Thanks so much for joining us for this deep dive.
Until next time.